In this week's video, we'll review the latest charts to help us answer the question, has the stock market's topping process reached a point of no return? S&P 500 daily as of the close on Friday, May 24th, 2019. In the slides that follow, we'll be water testing the following statements. The stock market has a failed breakout near a critical area after making an all-time high. The current correction, primarily based on renewed concerns about the trade war, negates previous bullish setups. Sideways action and failed breakouts are hallmarks of major stock market peaks. And finally, we should not be seeing a pullback of this nature after the recent rare turn in market momentum and after a strong breath thrust. Thus, given what we know today, should we take the analysis from May 18th, 2019 and throw it in the trash can? And has the present day market negated the breath thrust that we covered back on January 21st, 2019? As we walk forward, it might be helpful to know the present day drawdown in the current correction on a closing basis from peak to trough is 4.55%. If we use intraday figures, we're at 5.17%. While it would have been fair to say we haven't had a bear market since 2008, at this point in 2012, we should keep in mind that we came very, very close from a psychological perspective to meeting the somewhat arbitrary standard of a bear market when the S&P 500 fell 19.39%. And everything that we just said about the previous chart applies to the present day chart. I think you could make a rational argument that when the market reaches this type of decline, that many of the institutions step in and treat it as if a bear market has just taken place. Now we'll walk through some historical cases and compare them to the present day. This is a breadth indicator here. This is Nasdaq advancing volume minus declining volume. The lower portion of your screen shows the S&P 500. This is the major stock market peak that occurred in October of 2007. The market made a new all-time high and then had a failed breakout. And since we know the Nasdaq and S&P 500 have an extremely high and consistent correlation, it is legitimate to pair this indicator with this index. We still get excellent information about the S&P 500 when we look at the health of the Nasdaq. In short, the breadth indicator looked very, very similar to the stock market in October of 2007. We already know the S&P 500 has a similar look in the present day. How does the breadth indicator look in the present day? Better, worse, or about the same? Here's the failed breakout in the S&P 500 in late May 2019. And the answer to the previous question is much, much better. While the stock market has a failed breakout, we have somewhat of a positive breakout divergence, meaning the indicator has pulled back, but it's not anywhere near losing the breakout here, and you can make an argument this is a much stronger look relative to the failed breakout look that was in place at the major stock market peak in October of 2007. What happens if we compare the present day to the major peak that occurred in March of 2000 in the S&P 500? In this case, the S&P 500 tried to make a run at a new all-time closing high in the August-September timeframe and was unable to do it. In this case, did our breadth indicator look better, worse, or about the same relative to the look of the market? The answer is quite a bit worse. The slope of this line is basically flat. The slope of this line shows somewhat of a negative divergence. And we already know this indicator in the present day really doesn't look anything like this. It looks much, much healthier. You can make an argument this is indicative of institutions buying Nasdaq stocks, and you can make an argument that this is indicative of the institutions running for the exits. And this is a much more concerning look relative to this look on May 23rd, 2019. This Nasdaq indicator is volume-based. Now let's look at a similar indicator for the NYSE composite, but in this case it's based on issues that are advancing and issues that are declining. NYSE advanced decline line, this is the major stock market peak in March of 2000. This is the exact same chart when the stock market peaked in October of 2007. Does the present day look better, worse, or about the same? The answer is much, much better. The exact same indicator on May 23rd has made a significant higher high relative to this high. These are lower lows relative to the S&P 500 down here, and there was a breadth divergence in place for almost 2 years in this case. Based on the facts that we have in hand today, this is a much more favorable and positive look relative to these concerning looks on the left and in the center. Back to the present day chart of the S&P 500. Can we find cases in history that have a similar, we almost hit the bear market standard look, and then we rallied to a new high and had a failed breakout look? This is somewhat of a unique psychological setup. Why? Some market participants have treated this as a bear market and a great time to buy. Some market participants are still saying we haven't had a bear market since 2008. We have a failed breakout, and it's inevitable that a bear market is around the corner, setting up somewhat of a unique psychological situation where some market participants are viewing the market in a different light from others. Can we find similar setups in history with a plunge, a breakout to new highs, and a failed breakout? The answer is yes. 1978 almost hit the 20% threshold, but did not. The market rallied to a new high here, had a failed breakout, a 10.25% correction, and a somewhat concerning head and shoulders look here with an even more bearish downward sloping neckline in the S&P 500. What happened next from this point here after the 10.25% correction and after the failed breakout? From this point A here, the S&P 500 eventually rallied over 40%, and it would have been very, very difficult to try to trade around this volatility and capture what turned out to be an extremely satisfying return. Any other historical cases similar to the setup that we have in the present day? The answer is yes. 1990, the market saw a significant and rapid decline and then rallied to a new all-time high and then plunged almost 20%. Very, very similar to the setup that we have in the present day. We rallied sharply to a new all-time high, had a failed breakout look, then rallied to a new all-time high again, and then came back and retested this area here, and this involved a pullback of 5.64%. So this chart here is a very good historical representation of legitimate concerns that we might have in the present day. In this historical case, would it have been prudent and satisfying to run for the exits when the breakout failed, or to run for the exits and say, I've had enough during this 5.64% pullback, which is another way of saying what happened next from this point here at the end of this pullback? The answer is the retest in this case passed and the market ended up rallying almost 31% from point A to point B. How about from a longer term perspective? What happened after months and months and months of consolidation, a big plunge, and somewhat of a failed breakout look over and over again? If we extend this chart out even further, from this point A here, which is shown here, the S&P 500 rallied 315% in the coming years. Any other historical cases that we might be able to learn from? The answer is yes. 1998, market makes a new all-time high, pulls back, rallies sharply to a new all-time high, and then plunges almost 20%, rallies sharply and makes a new all-time high in a very, very similar area to the previous all-time high, sees a failed and very concerning breakout look, and then pulls back 4.29%. What happened next from this point A here? The S&P 500 righted itself and rallied 33.85% from this point A to this point B. Any other historical cases that look similar to May of 2019? Before we cover the similar case from 2011, a fair question might be, well, you're cherry picking the best cases. The answer is no. We're covering every single similar setup where the market plunged almost 20% but did not reach the 20% threshold on a closing basis, every single case between 1950 and the present day. Big plunge, market rallies to a new high, gets a failed breakout look, falls in a very, very concerning manner, almost 10%. What happened next? From the same point A here, the market rallied, recaptured the breakout level, and ended up tacking on almost 67% between point A and point B. And if we look out even further, was prudent patience rewarded in this area here? From a risk-reward perspective, the answer was yes. A 10% correction is a pretty good trade-off relative to the potential for almost a 130% gain in the S&P 500. What did the longer-term risk-reward look like here when we had this very concerning failed breakout look at a very, very critical area? If you were able to hold tight during this 10.25% correction, if we walk forward from this point A, from a very long-term perspective, after the 10.25% correction, the S&P 500 tacked on an additional 1,429%, simply telling us to keep an open mind, even with an admittedly concerning failed breakout look in May of 2019. We're going to continue using a weight of the evidence approach. As we walk forward, we'll be asking ourselves, does the evidence that we have in hand support or contradict this evidence? Does it support or contradict this evidence? Can we find anything else that aligns with this look or contradicts this look? And history shows us that good things can happen from a very concerning setup. Can we find anything else in the present day that supports a theory of possibly trying to remain patient? Respecting this is a noisy chart. It's relatively simple if we walk through it slowly. This is S&P 500 stocks above their 50-day exponential moving average. Thus, it is another breadth indicator. This represents an extremely rare oversold level in late 2018. If we work backwards, same level was hit in 2015, 2011, 2008, and 2002. And these are the only instances dating back to 1999. And in each of these cases, the indicator moved from the red line all the way up to the green line. Red to green. This is our line in the sand, this date here. Lower line to upper line, line in the sand, line in the sand, line in the sand, and this is the similar date in the present day. Thus, we have a similar breadth thrust to what took place from the low in 2002 to this point here in 2003. Anything else that's similar in this period to the present day? The answer is absolutely positively yes. The market rallies off of a low, breaks out above what we call plunge resistance. A big plunge starts from this point here, often on the way back up. That can represent a very, very important area. We get a failed breakout with a broken trend line here, and the market drops 4.57%. Very, very similar to the drawdown that we have in the present day. Thus, we have a breadth thrust that's similar to 2018 and 2019, and we have a chart pattern that has very, very similar characteristics to the present day, telling us the psychology and action of market participants in this period here is similar to the psychology and actions taken by market participants in the present day. What happened next from this point here? After the relatively tame 4.57% pullback, the S&P 500 rallied 62% in the coming years and never revisited this level here that is very, very similar to the present day. Why this is relevant in the present day? This point here is similar to February of this year. So what we're trying to figure out is how big of a drawdown did we have to withstand in these historical cases to capture what turned out to be a satisfying return. We'll walk through the remaining cases quickly since they illustrate similar concepts. This move here is similar to this move here. 2009 similar to 2019. How does the S&P 500's chart pattern look in here? It's the major stock market low in March of 2009. Market rallies off of a low, has a breakout and a failed breakout, and we fail near plunge resistance. What happened next from this point here? This is the area in here where the breadth thrust takes place, the thrust that is similar to the thrust that we've seen in 2018 and 2019. The S&P 500 after the thrust pulled back 7%. What happened next from this point here? The S&P 500 never revisited this level here and rallied over 200% in the subsequent years, simply telling us to keep an open mind about better than expected outcomes in the present day. Let's move to the 2011 case. Similar situation, strong rally off a low. We fail at a plunge resistance area. We have a false breakout, a failed breakout. The market falls almost 10%. This is the region here that experiences the rare breadth thrust that's similar to the present day. If you were able to withstand the roughly 10% correction, the market never revisited that low, and good things happened for a long period of time. Similar concepts. We move from the low end of the line, a very rare level, to the green line. This move here is similar to this move here. What did the S&P 500 look like at this point here? Similar to the present day, we have a sharp rally off a low, a breakout in an area where the market has had trouble in the past, and it also represents an area of plunge resistance. And that concept of plunge resistance in the present day can be seen here. This is where a plunge starts. We're having trouble recapturing that area. This is where a plunge started in 2015, where another leg down started in 2015, early 2016. Similar to the present day, we're having trouble breaking out above this area here. The market pulled back roughly 3%, and in this case, we did exceed this low here, but the drawdown wasn't that bad. Looking out a few weeks, we had a 5.6% drawdown in the same basic area, telling us it is within the realm of possibility that the S&P 500 will bounce around in the same general area in a violent manner for a few weeks or few months, and then it would still be in the realm of possibility to get a successful breakout, a retest of that level months down the road, and then a strong rally. Remember, we're taking a weight of the evidence approach. Is there anything else that's relevant? Yes, this is the Nasdaq Summation Index. We're looking at all the data that Stock Charts has back to 1988. This is a rare move here. See the black line, how we shoot up, shoot up, shoot up, shoot up, and shoot up. If we look at the magnitude of these thrusts, the present day is right in the middle of these four cases. Very, very similar to the magnitude of the move that occurred near the 2003 low, similar to the magnitude of the move that occurred near the 2009 low, and even more oversold and thrustworthy relative to the 1998 period and 2016 period. And we've already covered something similar in the 1998 period to the present day, so this is another data set that ties 1998 to the present day, and 1998 also has a very, very similar chart pattern. And if you know your market history from this point here, this point here, this point here, and this point here, which is similar to this point here, good things happened in the S&P 500 index in each of the historical cases. Anything else that we have that supports the important breadth thrust hypothesis relative to the present day? Yes, NYSE record high percent index, extremely oversold level last year, late in the year. Worse than the oversold nature of this indicator in 2016, and more oversold than the level seen in 2011. We know from this area here, we had a thrust, and in this case, we made it from very low levels back to the same green line. And in the historical cases, good things happen for a long period of time. 2019 falls into the to be determined category. It's possible you might have been thinking earlier in this video that nobody uses the exponential moving average with these breadth indicators. Well, that may or may not be the case, but in any event, we have a similar look using a simple moving average, S&P 500 stocks above the simple 50-day moving average. Very, very rare readings in the orange boxes, and rare to go from this lower level up to the green line here. After these 3 points, which are similar to this point here in 2019, the average and median drawdown in the S&P 500 was roughly, let's say, 4.5%. And these figures are based on 10 drawdowns that occurred in relatively close proximity to these signals. These figures here align well with the drawdown that we've seen thus far, which is 4.55% on a closing basis. We've also shown numerous drawdowns in this video in similar situations where it almost reached 10%, telling us to keep an open mind about seeing this number increase in the days, weeks, and months ahead. Let's talk a little bit about what can be a psychological hurdle for investors. It would be relatively rational to think, how is it possible for people to keep paying more and more for the same 500 companies? Which is another way of saying, how is it possible for the market to do anything even remotely similar to the historical cases that we've presented? Which is another way of saying, how is it possible for the market, for the most part, from a trend perspective, to continually make higher highs? From the beginning of 1934 to the present day, the gain in the Dow has been astronomical. How is it possible for that to happen? In all reality, over a long period of time, investors are not paying more and more for the same companies year after year after year. Since it has fewer components and it's a little bit easier to do a quick cross-reference, the answer is the makeup of the major indices change over time. Dow Jones Industrial Average in 2018, only 18 of the components were in the Dow in 1997. 1991, only 15 components overlap from the right side of your screen to the left side. 1976, only 5 overlaps. And we have an asterisk here because it's possible you have takeovers or name changes. This is just a quick estimate of the companies that overlap. If this number is 7 or 6 or 4, the concepts are still the same. Thus, investors are not paying more and more for the same companies in 2018, given only 2 companies overlap in the Dow going back to 1956. 1935, 3 companies overlap. 1916, 0 overlap between the Dow in 2018 and the Dow in this period here. And the same can be said for the first Dow Jones Industrial Average in May of 1896. And ultimately, the answer to how can investors keep driving the same stocks higher and higher is related to these concepts here, which speak to human innovation and change. And it's not simply turnover in the index. Companies that have been in the index for a very long period of time can be worth more because they've been growing their earnings over time. And we know with 100% certainty, if you've been able to stay in the Dow for decades or a long period of time, that speaks to innovation and excellent management and leadership to remain relevant. The same concepts apply to 2019. Innovation and change are inevitable. And it's helpful to review charts like this because it can get us out of a very short-term thought process. A 7% correction sounds extremely painful, and in real time it is. But relative to a 226% gain, this is a relatively small price to pay. And these concepts also speak to what is, for the most part, a perpetual concern about some companies getting too big. The government brought an antitrust case against IBM. It's a New York Times article dated February 15th, 1981. And from a relevance perspective, it is possible that IBM could drop out of the Dow in the coming years. IBM dominated the hardware and mainframe business. A lot has changed since then. The concerns about Microsoft dominating the PC business and the browser business were not only addressed by the U.S. government, as this May 11th, 2011 Seattle Times article points out. We all know market shift. It's interesting to note, this article is dated May of 2011, which happened to be the peak in PC sales. Since then, things have changed considerably. IBM, hardware mainframes. Microsoft, personal computers and software. Our big guns in the present day, most of them internet related. Highly unlikely that the names are exactly the same and we have the exact same dominant players 30 to 50 years down the road. All of these companies and brands on your screen were part of the Nifty 50 in the late 60s and early 70s. These were dominant brands in their day. Some of these brands are still very viable today, and they represent successful businesses, but they're not the dominant brands that they once were. Here's a little blurb about the Nifty 50 here from USA Today. And here are Interbrand's best global brands in the year 2000. If we fast forward to 2017, out of the top 6, IBM, Intel, Nokia, and GE. In the present day, we're not really sure if GE is going to be a viable entity going forward. That's to be determined. In the year 2000, it was the 6th most valuable brand. Coke and Microsoft still on the list, but they've fallen. In this video, we've shown hard evidence that says the present day really doesn't look that much like the major peak in 2007, nor like the major peak in 2000. And we've shown several examples and forms of hard evidence that say the present day looks like the major bottoms that formed between 2002 and 2003 and 2008 and 2009. Is there anything else that supports that hypothesis or theory that the present day looks more like a major low rather than a major peak? The answer is yes. Sentiment Trader, Twitter handle here. Since the inception of the S&P 500 futures market, there have been 2 time periods with this much pre-market anxiety. The bottom of the 2002 bear market, a major bottom. The bottom of the 2008 bear market, a major bottom. In the third case, the present day, helping us with the weight of the evidence approach. How about the economy from Urban Carmel this week? Recent highs in housing, employment, leading economic indicators in the S&P 500 tell us the present day doesn't really look like an economy in an early contraction or pre-recession stage, and the 10-2 yield curve also, from a weight of the evidence perspective, supports that hypothesis. Everything on the screen here doesn't do anything to discount this theory and this data set, and everything in Urban's tweet also aligns with this theory relative to these major peaks and the fact that the present day looks much, much better. Everything that we've said in this video is based on the facts that we have in hand today. If the facts change, then our assessment of the probabilities must change. We also have to keep an open mind, even if, and that's to be determined, good things happen for a long period of time. It is quite possible that the S&P 500 will at least go back and fill this gap here, which would take the drawdown in the present day from the 4 to 5% range to at least a roughly 7% drawdown. And it's extremely important to note our present day allocations really have nothing to do with any of these historical analogies or studies. These studies simply help us understand the probability of the present day and the present day data deteriorating and morphing into something like March of 2000 or October of 2007. The hard data that we have in hand today, which dictates how we allocate and invest, aligns with really everything that we've covered in this video. The trend strength model, which is one portion of the CCM market model, actually has 2 components. We split it out. The short-term score, is roughly 97, and the long-term score is 100 on a scale of 0 to 100. Also telling us to keep an open mind about better than expected outcomes in the days, weeks, months, years, and decades ahead. If we're going to execute properly going forward, it's extremely important that we head into next week and every week with that flexible, unbiased, and open mind. It may also be worth a visit to the new website to see the FAQs. We've got new and expanded FAQs covering traditional investing, low-cost passive investing, and the online/robo strategies that are currently in vogue. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.